Hey, everybody. Welcome to the No Shill Zone. Ben and I are back at it, giving you guys the best data that we can. Not the hopes, not the hopium, not the dreams, but the actual reality of the situation. Ben, where should we get started today, buddy?
I think everyone wants to talk about altcoins. That seems to be sort of, the things that are moving. So why don't we talk about the altcoin market and how it relates to Bitcoin dominance?
Yeah, I think that's a great place to start. So obviously, unless you've lived under a rock, we know that altcoins are surging. We've seen Solana, we've seen Litecoin, I mean, you name it, almost every altcoin is up 50 to 100% in the last week and a half, right? So the question is, we're seeing dominance starting to collapse. Ben, what are you thinking in terms of where dominance goes? Like, does Bitcoin start to regain its mojo?
Yeah, I mean, so normally what we've seen is, we've seen a period of a phase where Bitcoin dominance will move higher aggressively, and then it'll pull back some. But the problem is that every time it pulls back, it leads a lot of people to saying like, oh, this time is different, and this is where the dominance is going to collapse. But what ends up happening is the altcoin market just ends up putting in a lower high on their Bitcoin pairs, right? And so in the same way, back over here, I mean, I'm sure everyone remembers when dominance sort of pulled back to 49%. And we even came out and said then, guys, look, this is probably going to hold as support. It's a perfect retest of where it broke out. I'm almost wondering if the same could be said here again, right? So it sort of broke out to that 52% level, came under, broke out here above 52 all the way up to 54. Perhaps that is the level to look at to see if it can find support. So I'm curious. Yeah, I mean, in the short term, there's a lot of momentum, of course, with altcoins, but I would be leaning towards the idea that the dominance finds a low somewhere around this 52% level and then proceeds to go higher.
Yeah, so I'll just throw up my chart, and I mean, again, it shows you that Ben and I didn't discuss this necessarily ahead of time, but that's exactly what the technicals are insinuating, which again is probabilities, folks. Right? I always stress this is that when you deal with data, you deal with being able to decipher the likely scenario versus the less likely scenario, and really that's what it is, right? So we know that some of these altcoins are getting very extended. They're great runs, not to take anything away from them. It's an amazing move, but you've seen Bitcoin dominance come in, and I have that exact same level. So you're looking just basically above or fractionally above 52% on Bitcoin dominance as where that would be, in my opinion, where you see, and again, it could be two things. It could be where the whole crypto market drops, but Bitcoin only drops 3%, while the altcoins drop 10, right? I mean, that's one way dominance could expand, or
Right.
the altcoins are done, they take a breather, and Bitcoin starts to power up. That could be a result of maybe the spot ETF gets approved. I mean, there's so many
Right.
different possibilities of how dominance could move there. But I think that's exactly right. And I think it's worth just taking a look at some of these charts. Like I do want to touch base on Solana. Solana's had an amazing move up here. Um, Interestingly enough, we're now at this level of resistance. And one of the things that I'm actually short Solana right now. So I am short Solana. But the high here, you can see this little pivot right here. That so far has been the high. And one thing to always watch for is see this one green candle, two and three. And when you were all the way up here on this green candle, it was by far the biggest of the three. Usually, when the last candle is the biggest of the three and then forms a tail, that's called a blow off top, which is a short term high pivot. And that's just standard technical analysis right there. So, as of now, Solana has a top until proven otherwise. Now, other coins are starting to run. For instance, I was just looking at Litecoin. Litecoin's finally broken out. I have a target on that of around $79 to $80. There were some other ones too. I mean, all these obscure ones that I don't really know much about. INJ. Look at this run on this thing. I mean, it had this beautiful little wedge pattern, finally broke out. And I mean, it's gone from mid-October, so basically less than a month ago, $7 it was, and now it's at 17 and change. So these have been amazing moves. There's nothing to take away from it. But for me, this is where I start. I mean, just as a technician and a shorter term trader, I start to look at shorting opportunities when emotion starts to take over and it's not so much technicals anymore.
Gareth, I mean, I think it's also important to point out to people is, a couple of weeks ago, you were pretty bullish on the altcoin, on a lot of these altcoins, on their USD pairs, and I don't know. I mean, I know you've been playing those for a few weeks, so just as a reminder, right? flip bias on shorter time frames as well. So congrats on sort of
Thank you.
that.
Thank you. And just to keep everyone in the loop on what I've done, and I always try to keep it transparent. So over the last week, I've been inching out of those. The only thing I have left on the long side now is Litecoin. So Litecoin, I'm still riding. I still think maybe that gets up to that target we talked about. And now slowly I've been inching into the short side. I got a little bit of chain link on the short side, a little INJ as well that we just talked about, that crazy move, Solana and some of these. And again, it's important to recognize that I'm a DCA trader, and that means dollar cost average if you don't know. And I do that on the long side and the short side. So like I've learned my lesson where short squeezes are unbelievably powerful. So I start small, and then if it goes up another X%, I add a little bit more. And ultimately what you do is you get these charts that they just go crazy, and eventually you'll get that pullback. And if not, then my stop obviously has to be honored at that point. But these are shorter term investments that I do. But I think, again, once emotion takes over, that's where I thrive. When everyone is trading on emotion, not everyone, but a majority of investors, once you get emotional, that's where the technicals and the data become most important. And I think, Ben, you've seen that in so many charts. I mean, think about Bitcoin when it was at the highs and the emotion there, and vice versa at different levels.
Yeah, and one chart we've talked a little bit about is sort of like a sort of like a derivative of Bitcoin dominance, but it's this like total 3 minus USDT divided by Bitcoin market cap chart. And I don't know if you remember, but back in the summer, we said, all right, this is probably going to come in for a bounce. Like alt Bitcoin pairs will likely bounce, just like they did over here back in 2018. But then what you'll notice is that it came back into that same level, right here, got a smaller bounce, and then it ultimately resolved to the downside. So I really do wonder if that's what's going on here, right? It's a smaller bounce, but ultimately does not take out this high, right? So this high up here would be close to around 50%. Because it went to 49%. So to put in a higher high, you'd have to see this go to 50%. Right now it's at 44%. So I sort of suspect that it will just be a lower high and a higher low on dominance, right? So higher low on Bitcoin dominance, a lower high on alt Bitcoin pairs. Note that this period over here where alt Bitcoin pairs finally broke down, it was in a period like this, right? Where Bitcoin went up a lot, but not only did it go up in June, it also went back up in July to form like a double top back in 2019. So you could see a scenario, right, where Bitcoin just keeps getting these pops. I mean, it pulls back, it pops back up, and it keeps breaking the altcoin market down to their Bitcoin pairs. And I know, right now in the short term, alts are up a lot on their USD pairs. If you were to take a look at ADA Bitcoin, I mean, this is a pretty significant move, right? But you still have to wonder, is it not just kind of back testing the prior breakdown point? And also, if you look at something like the RSI on some of this stuff, every time that ADA Bitcoin has hit this overbought level, it ended up marking sort of a local high, right? So it's possible that these runs can extend a little bit longer, but I still think Bitcoin will absorb that liquidity from the altcoin market, and I think dominance will continue to go higher.
Yeah, no, I think that makes sense. I mean, you can't fight the trend, right? I mean, that's the biggest thing. And that was in the bull market and then in the bear market. And then that applies to dominance as well. And dominance broke out. We know that. And then dominance continues to make higher highs and higher lows with retraces. And I think that's what we're seeing right now. I do have the chart on Matic here, Polygon. I just want to show this. So Matic is actually hitting some resistance today at this 71, 72 cent level. And if we zoom out, you can see where that line comes from, right? From all this consolidation right in here, that was right around that 72-ish cent level. So you're hitting some resistance on that one. If it does break, which is always a possibility, next level would be around 84 cents on Matic. But again, you're starting to get extended. You had up move and then consolidation, up move here. I want to show you guys one technique that I use. It's called the measured move tactics. So essentially you take the initial move from the peak to the trough, and what we see is that's 15 to 16 cents. And then you take the secondary move here, and you can basically map it out. So if we go up and complete a measured move that gets us towards that next level up here. That would be kind of your maximum upside potential on Matic, getting towards that 80-cent level. But yeah, I mean, I think again, it's fascinating. It's nice because I think so many, and we were talking about this before. So number one, the euphoria I'm seeing in the altcoin market with so many crap coins again rallying 100+% probably means that it's not over for the altcoins in terms of the negativity and the downside. And then the number two thing is, like, you have to also understand that this is like a caged animal. The altcoins just kept going down and going down and going down. And so now it's almost like an animal that's broken out and they're just like euphoric, right? They're like, holy cow, this is how the bull market was. Let me go crazy and just dump money in, which creates these oversized moves. So the question is, when the dust settles, where are these altcoins trading?
Yeah, I think it's important to remind people, ultimately one of the reasons why probably both of us remain bullish on Bitcoin dominance and bearish on all Bitcoin pairs is we're still in a tightening cycle, right?
Yeah.
And I remind myself constantly that dominance last cycle did not top out until the Fed started cutting rates, right? And from a fundamental perspective, Gareth, I know you like it makes complete sense, right? It's not till you go back to looser monetary policy that the riskier things start to outperform Bitcoin.
Right.
So that's the, and a lot of people ask me, like, why am I so biased against the altcoin market? They'll call me a Bitcoin maxi and whatnot, but it has nothing to do with that, right? It just has to do with tighter and tighter monetary policy and kind of recognizing that alts don't tend to bottom out against Bitcoin until we go back to looser monetary policy. Now, Gareth, maybe this is a time to potentially pivot into monetary policy and what would eventually cause the Fed to pivot. I mean, I know you've talked about it a long time, and you've previously said that you think the Fed will be a little bit later to pivot this time because of high inflation. Are you still think that's the case?
I do. I really do. And I think the kicker on that is that inflation is abnormally high still, right? So we're still north of 3%. So as long as we stay north of 3%, the Fed is not going to want to repeat what happened in the 70s and 80s, where they began to cut too quickly and then you had that second leg up. In fact, I think you even have a chart of that showing how inflation worked during that period and how it came in real quickly, but then it surged back to the upside again in terms of the inflation move. And I think that's what Jerome Powell has said very clearly. Yeah. So, I mean, he does not want to repeat that move, which is understandable. I mean, imagine inflation going to 15 or 16% after it topped out around 9 to 10%. So my guess is they will cut. They'll do like a couple mercy cuts, which will try to stabilize the markets, but they will be very reluctant to come out with guns blazing again, unless for some reason that inflation gets down to sub 2%, because they know the end game, right? I mean, you have history on your side in terms of reading what happened or learning from history.
I noticed that the cuts that previously were expected to start in June or July have now been shifted forward another month to May. And I think I guess one of the reasons for that is because the labor market is showing signs of some weakness, right? I mean, if you looked at what came in last week, we got a new high for the unemployment rate. I think for the first time since I think this is the highest it's been since maybe 2022 began, around 3.9% or so. So it is getting pretty high up there. And there's a video I just put out on the SOM rule recession indicator. And this is getting pretty close to triggering that threshold. So basically what it states is that if the unemployment rate, if the 3-month moving average of the unemployment rate increases by 0.5 percentage points off the low from the previous year, then it tends to correspond to a recession. And it tends to be within about a 3-month window that it predicts it, right? So anytime it goes above that 0.5% level, that's tend to be around the time of an onset of a recession. So I think that's the issue, is it's starting to make that move. So we'll see where the labor market comes in next month. But how long? I mean, I think that the Fed's job has been so easy for the last year, right? Or 2 years, right? You just hike because inflation's high. There's really not been a trade-off because the labor market has been strong. What do they do in 2024 if the labor market's not as strong?
Yeah, and one of the things I think that's interesting, because it coincides with this rally in crypto, as well as, stocks have rallied just in the last week, but I don't think that's necessarily a point of it. But I believe that global M2 is actually up because of China printing and some of these other countries. Like China has come out gangbusters with additional liquidity. So, in the very least, even though the US is tightening, you could make a case that at least
Right.
crypto has a neutral to positive flow of money right now, which again could be why we see these altcoins running as much as they are.
So this is like M2 for the United States, Japan, Europe, and China. Okay. So yeah, like it's basically off the recent lows from September. You can see it's basically just been putting in. It sort of hit a high in April, and then a low in June, and then a lower high in July, and then a lower low in September, and now it's moving back up again. But perhaps it'll just be another lower high.
Yeah. Yeah, absolutely. And you do have a classic. I mean, that's almost like Bitcoin's chart in a way. You had the second high being a little bit higher in that respect. And so I think that's, at least for me in terms of crypto, I think, for me, I'm looking at and saying, okay, I think that potentially Bitcoin can still go up a little bit more. It's consolidating here on the chart. In fact, I can bring up my Bitcoin chart right now and we can just take a quick look at it. So I don't like sideways to upsloping channel consolidation. It's usually a weaker consolidation pattern if you look historically at this pattern, but again, still potentially has the ability to break through 35 to 36,000 here. But again, what I would say is that based on history, at some point we retrace to 31 to 32, whether we get the pop on some sort of spot ETF first or not. If we do, I will be shorting into that pretty heavily into that move. Somewhere in the mid 40s, I would say, would be that upside move. And again, short-term trade, and then I'd rebuy at 31 to 32. Just classic little play the levels, ping pong at the levels, and so forth. What are your thoughts on, last week we had the Fed, right, Ben? The Fed basically came out and said, hey, we're still going to be, higher for longer, but needless to say, the market did say, like you showed, that rates are now expected to drop sooner than they were prior to that. So what's the take on that? Do you have thoughts on that in terms of where we're going?
Yeah, well, I think there's a couple of things. First of all, there's a couple of things that happened last week, right? You potentially had, I think the market is basically saying the Fed's done, right? I think the market's saying, no, you're not going to hike again. We don't believe the SEP. And I don't think Powell even believes the SEP at this point, if you listen to what he said during the conference, right? So I think, this is your typical like pause rally where you get a pause, and in the short term, right? In the short term, that's been bullish for risk assets, right? You also had another thing that happened last week, and that was Yellen came out with shorter duration than the market was the market was pricing in, and that was bullish for bonds, right? So it was bearish for like the long end of the yield curve, and if the long end of the yield curve is going down, that tends to be bullish for risk assets. The thing that I would sort of point to answer your question is, if you were to look at let's say like 10-year treasury yields, the thing that and this is what I look back at when I look at a typical business cycle, right? So if you were to overlay the S&P 500 with the 10-year, so right, if the 10-year is dropping, that means, the long end of the yield curve, or sorry, that means like bonds are going up, right? If the long end of the yield curve is dropping. But if you look back at the last two business cycles, what we'll see here is, let's first look at 2007, right? You can see that the 10-year topped out in June, and in the short term, stocks got a little bit of a pop, right? So the 10-year topped out. That's where bonds bottomed. The S&P saw a short-term move to the upside. But the issue was that a few months later, the market realized why the 10-year was going down, right? And why the bond market was going back up. And it was because something was wrong with the economy. And then you can see that the 10-year continued to go down. And while in the short term, it was bullish for risk assets for a couple of months, it eventually resolved to the downside. Same thing the cycle before that, right? You can see that the 10-year topped out in January. The S&P continued to slowly go up, right, for another several months, not much higher than where it had already gone, but a little bit higher. But then eventually, as the 10-year continued to go down, then the market recognized, like, okay, this is why it's going down. It's because we're going into a recession. So I'm of the opinion that is what's happening, right? You're getting your typical, your typical rally after a pause, after bonds have potentially bottomed. They still could theoretically go lower. And again, these moves can last for several months before they ultimately roll over. So
And I think it's kind of coming at the right time, right? We're getting into the fourth quarter, that we call it the Christmas rally. Like, it's make
right.
everyone jovial into the holidays and sort of thing. And I just want to show this. So this is kind of in line with that, is that you have this sort of pattern on the S&P 500. And by the way, this move on the S&P in the last week has been tremendous. So historically, this is an over 5% move. That's very, very rare to get over a 5% move in the S&P in just 5 trading days. So huge move up. I looked up the stats, and I think it's like a majority of the time you'll see a 0.8% retrace the next week. So I'm kind of curious if we do get that little retrace. Then the question is, well, where does it go? Because you have a lot of technicians talking about cup and handle pattern, right? So I'm hearing that every which way. The one thing I want to throw out there, and I've traded again now 24 years of trading technicals, is that cups, the best cup and handle patterns are basically like this, right? So like this, and you go up and hit your double top and then make your handle. This is a lower handle. So again, just be aware, historically speaking, this doesn't mean it's not a cup and handle, but the probabilities of it playing out are less than if you had the double top hit and then the pullback. So just again, I always like to throw that out there, is that the common chatter these days on so many places and Twitter and everywhere else is, oh, it's a cup and handle, we're going to go to new all-time highs. Probability wise, that's actually not favored here based on history. And you actually don't even have to go that far back. Simply go back to the NASDAQ, right? If we go to the NASDAQ 100 here, and we flip over to, that's not the right NASDAQ chart. Let me get the one that goes back here, NASDAQ composite. So if we go back to the .com era, we can see that essentially the same sort of pattern happened. And, you had people, same thing. Oh, look, it's forming a cup, right? And then before you know it, you collapse back down, which again happened again and again. And we're making that same sort of pattern here that we did in 2000 on the .com. So again, it doesn't mean it can't play out. I do think that you're going to get some sort of continued move up in the next month or two, because like we've talked about, when initially rates stop going up, there's this general like breath of sigh of relief until people realize that, holy crap, we're going into a bad recession, and then dropping rates actually becomes bad. But yeah, man, I mean, I think it's a super interesting period we're entering in the next few months, where this market's going to figure itself out.
Well, I think, in terms of thinking about both sides, right? I think it ultimately comes down to whether 5.5% is above our start, right? Like if it's above the neutral rate, if 5.5% is sufficiently restrictive, then it should slow down the economy. It should, go into earnings, and then that should be reflected in lower asset prices.
Right.
I think the other case would be that if it's not sufficiently restrictive, right? If like the neutral rate, and let's say the neutral rate is higher than 5.5%, and the economy can still expand under 5.5%, then that's how the soft landing happens. But I think the issue, and again, doesn't mean it can't happen. It could happen. I think the issue though with a soft landing is what would likely happen similar to the 70s, where you basically just kind of go sideways for 10 years because you just get inflation expectations. Inflation just becomes entrenched.
Yeah.
Because I mean, like, it's all the wealth effect, right? I mean, if the S&P were to rally, then it's going to lead to more spending, right? Consumers are going to feel wealthier, so they're more likely to spend. That's going to put upward pressure on inflation. By the way, we've talked about this chart before. This is the S&P year-to-date ROI compared to the average of all prior pre-election years. So it did get this pretty typical correction that it normally gets, July or like August, September, October. The interesting thing is this pop by the S&P up to about 1.11. That's actually right around, a little lower, but right around the level that the S&P normally ends the year of pre-election years, is right around this level. So, I certainly wouldn't be surprised to it could certainly go higher, but I wouldn't also be surprised to just see it sort of chop around for the remainder of the year. This move here, while it has been pretty aggressive, it could always come back in and then pop back up a little bit. I wouldn't be surprised to see that as well.
I find it interesting what you were saying, that you were mentioning about like a potential for a market to just go sideways for a long period of time. And I do think that people out there, and I've made this claim before, that I could see us not making new all-time highs for like 10 years. And people, again, generally newer investors that haven't experienced this or know about other markets are like, oh, dude, you're crazy. But you have to remember, the NASDAQ, after it put in the .com high, it took about 15 years for it to make a new all-time high. And historically speaking, you actually have this precedent set, whether it's in China right now with the Hang Seng markets, and I'll show that chart here as well, is that on the Hang Seng chart, right? So if we go to your weekly chart, you can go back to the high of 07, and you did double top. But look, I mean, where as an investor how have you done with this type of sideways action for a long period, right? And I think we've even talked about this: is Bitcoin going to make in the next bull market? Is it going to make a new high, or is it going to kind of come close but then back off? But just lastly, before we get into that, just keep an eye, and I think I've mentioned this before, but Brazil, again, which is one of my favorite investments now, it's borderline getting ready to break out. But if you invested in the high end of this market in '08, I mean, you have not seen any return on your money in a long time. And they got inflation too. So, I mean, you've really been hammered on that.
Well, like in the 70s, we did put in new highs, but then we just then went on to put in new lows. And that happened. I mean, like we had a high in 66 and then a low in 66 and then a new high in 68 and then a lower low in 70 and then a higher high in 73 and then a lower low in 74, right? And
Yeah.
I mean, it was I have to imagine that, like, imagine if YouTube existed back then, or Twitter, and basically, when you put in a new high, the bulls just get so euphoric because it put in a new high, and then a couple years later, you're putting in a new low. I mean, this must have been a brutal market.
Brutal.
Because going into it, it's not, you would have seen this, right? You wouldn't have known that this was what laid ahead, or just lower lows and higher highs for the next decade. One thing I wanted to point out too, before, it's always interesting to look at analogs of other bear markets. And again, I mean, it is a bear market until it puts in a new high, technically speaking, I suppose. But if you look at prior bear markets, and assuming, this is assuming the lows are not in, right? If the lows are in, then it's an irrelevant point. But if the lows are not in, then this blue line here, this sort of line right here, this is the current cycle. And then this one is the 1946 to 1949 bear market. And you can see that there was a downtrend. There was even a pretty big pop right here, right on the S&P back then. But eventually, it ultimately bled to a new low. And Gareth, the thing that I go back to, I know we have to wrap it up here in a second, but the thing that I go back to consistently is this whole yield curve inversion, like ROI to low after yield curve inversion. And I just want to pull out, like, say, the 2-year and the 10-year. Every single time we had an inverted yield curve, it's possible that the S&P moved higher, but what happened every single time in every single bear market coming out of that yield curve inversion is that eventually the market went lower than where it was at the time that the curve became inverted, right? It went below 1 every single prior bear market, right? And this is the current one. This is compared to the financial crisis, right? This is compared to the .com, right? Every single time it eventually made its way back to less than 1. Sometime it took years before that ultimately played out. But again, I do wonder if that will play out again.
I think that the last thing too I want to say is that I think people have to recognize that there are 2 scenarios ahead of us. And one is that the M2 continues to decline or stays stationary and the Fed keeps, tightening and we go into a recession. But at this stage, it's a recession that's probably needed, a pseudo reset. The negative would be is if the Fed loosens monetary policy and if our U.S. debt continues to climb at a record pace, you could get asset prices to get another balloon, right? I mean, you flood the money with markets, it's going to stimulate growth and it's going to stimulate inflation. Problem is, then you get into that 100-year cycle from 1929, which I would be more scared of. So weirdly enough, you add a lot of money to the system, let's say over the next couple of years. And while that would give us a short-term high, I think at some point, and I don't know about if you feel this way, but I think that at some point there has to be some sort of reset, right? I mean, you can't spend and spend and spend and never eventually pay off that debt.
Yeah. And I mean, money supply right now is actually, at least locally, right? I know globally it's going back up, but in the United States, you can see it got this bounce back in April. And a lot of people are sort of saying, okay, well, M2 is going back up, but actually it kind of topped out in June, and then it's been going back down again. So, I see sort of both sides. Like, I see the argument for both sides. I think for me though, my impression is that 5.5% is sufficiently restrictive. I think the bigger thing is can the Fed hold it there for
Right,
a long
hold the line.
It's higher. I mean, it's higher for longer. Is it all talk? Or is it actually going to play out? So
That's exactly what I think. I'm curious to see too. Is like, does the Fed essentially have a backbone? Right? Will they hold when people start to scream? And by the way, the biggest screamers are going to be the politicians because they have to get reelected every 4 years or so, or every 6 years. And so I mean, that's going to be the interesting thing is when you get all of them to start attacking the Fed. does the Fed crack or not? So,
Well, the
all
other
right,
thing,
guys. Whoops, sorry.
yeah, I was just gonna say one thing. The other thing too is a lot of times when the Fed starts cutting, that's where the market loses the most.
Yeah.
I mean, in prior cycles, it's where the cuts come, is where the market's dropping. But yeah, we should go ahead and wrap it up. So guys, if you're not following Gareth, make sure you do that. Links to his channel and his socials are in the description below, as well as to his website. Make sure you guys check that out, and we will see you next. Actually, next week we might have to change the time, but we will see you hopefully next week.
Yeah, we'll definitely do next week, guys. But I'll announce and we'll post up the time of it. But as always, guys, follow Ben on the socials below this stream. I thank him for joining me on this because I always think it's good to have. It's rare I get on a stream with people that are like-minded in terms of data versus hype and all that other stuff. So I appreciate you, Ben, and have a great rest of your week, buddy.
You too. We'll see you.
Bye.